And then we have our first draft, a rough draft of the next memo that's coming up that involves looking at break even for a restaurant. Over the years that I've done this kind of thing and had people come and ask questions about that, probably the most common business concept that somebody wants to start and think about is a restaurant of some sort. Now, right now, that probably would be a very tough sell, but uh, in more normal circumstances, what would they need to consider about fixed costs, uh, variable costs, that sort of thing? What would go into that concept, and how would they go about calculating break even in terms of sales, that sort of thing? So if, and again, we're writing a narrative about the thinking process, not necessarily doing calculations or showing numbers. So it's we're being asked for advice about how to help someone else go through the process. We're not interjecting in and saying these are the numbers or trying to come up with any numbers. You don't have to speculate as to what the dollars and cents might be, but you want to point out the considerations that they should have when they're thinking about whether or not this restaurant will be able to be successful and be profitable. So in doing so, make sure you are clear about what you consider, what you think the costs will be: fixed, variable, mixed, and what they should do uh, to determine those costs and that sort of thing. So that's what the memo is. And remember, the rough draft, we're looking for a professional business memo format. Make sure you've got the heading correct, that it is one page, single spaced, so that uh, you know, and then I'll give you feedback, and then you'll be able to correct that, make any updates, and it will be a final draft the last week of the semester. So, any questions about those two assignments? All right, then briefly, we will look at the midterm exam. The problem that gave people difficulty was the first one. I'm not going to spend time on the second one, because if you made mistakes on that one, it was almost entirely math related, uh, and so forth. So almost everybody got that correct. Uh, so we actually did very well at calculating this first part, uh, getting the variable cost per unit and the fixed overhead costs. Uh, then when we came down here, the contribution margin per unit, we were going to use the variable cost per unit for overhead, as well as the direct materials that were shown here and the direct labor that was given here. They had $180 to make 16 units of product. So roughly, on average, they're going to cost $11.25 per unit. So now you have direct materials, direct labor, variable overhead. Those are all your variable costs. The sales price is here. And the biggest mistake that folks made was leaving out one of those variable costs. Okay, either we only use the variable cost per unit for overhead and didn't do the direct material and direct labor, or we did this with direct labor and direct materials and not the variable overhead. But the correct way is to use them all. And then once we had that contribution, we applied it almost entirely correctly to calculate the break-even point. So taking the fixed costs, problem being, the only concern there was we had 26,500 in selling administrative costs that were fixed, and we had fixed overhead from our calculations up top in the fixed overhead cost per month. So those together should have been our fixed costs when we divided to get our break-even point. And then we did good on adding in the 30,000 and then dividing again. And we had a little more difficulty with the 100,000 because we need to either do it. There's two ways, remember, either 100,000 plus the fixed costs, divide by the contribution margin per unit, and then multiply by the sales price, or you can divide by the contribution margin ratio, the percentage. Either way gets you the same result. Okay. And then we did a couple of, we're to do a couple of contribution margin format income statements. One with sales at 7,100 units. We have our sales price, we have our variable cost per unit that we used, and most of us translated what we had done earlier into those correctly. All right. And then we just did some tweaking to that to come up with a new scenario with increases in selling costs, increases in machine fixed costs, and also a reduction in our direct labor per unit. So that is what we did. I've tried, but I realized that somebody pointed out earlier, came on, and my intention was to make corrections in the spreadsheet you attached and then re-put it in the Dropbox. But I obviously didn't do that in at least one case. So I will go back through and make sure that if I somehow didn't resave it onto the Dropbox, that I do that a second time. I know I did that with everybody, but there's an extra step I have to do to attach it to the Dropbox. And maybe I didn't do that in one case, at least one case. And so I'll look at them all so that you'll have individualized feedback as to what your errors were. Questions? All right. So you will have that. I will do that immediately after class today. So then we'll jump into chapter 5. Now, the big thing about chapter 5 versus chapter 4, chapter 4 were what we refer to as short-term decisions. And so when we considered things, we almost always were looking at things that were variable because that's what changes in the short run or over the next couple of months or the next year or whatever. We are completely changing our focus from entirely short-term considerations to entirely long-term considerations. So every decision and thinking we're going to make in chapter 5 has to do with more than 1 year. All right. And so in those cases, when you're talking about more than 1 year, any costs can change, even fixed costs. So they become more relevant in a long-term scenario because they can be adjusted, especially over 5 or 6 years. In fact, that's what we're usually considering, is an adjustment to our facility or to our equipment that is going to change our fixed costs going forward. All right, so that's how this relates to what we've already talked about and how it's different. So let me share this our PowerPoint. So the decision that we're making is typically, are we going to buy an asset that is going to impact not just this year, but could be 10, 15, 20 years, although we tend to do things on a little shorter time frame as far as just for example purposes, just because that makes our a little less work for us all. Okay, so as soon as we go beyond 1 year in accounting, we start thinking about the concept of interest. We don't usually worry about calculating interest or any type of form of interest on anything less than 1 year. So that's kind of a rough rule of thumb in accounting, is that that we don't worry about interest if it's short-term concepts, but we do when we're talking about long-term. So that's what's going to be different about this concept. So I want you to understand this idea of the time value of money. And that basically says that $1,000 today is not equal to $1,000 3 years from now. So 3 years is past that magic 1 year kind of mark. And therefore, that $1,000 3 years from now has got to include some interest. And so it is not just the same as having $1,000 today. No one would argue that they would rather have $1,000 3 years from now than they would have $1,000 now. $1,000 today is more valuable than it is than $1,000 3 years from now. Now, we can make them equal if we add to the amount in the future. Okay, so the $1,000 in 3 years is the same as a lesser amount today, plus the interest. So there's an amount in that future that is considered interest. And when we talk about what is going to happen in the future and we take that interest out, we call that the present value. So what we're doing when we want to think about a new asset is we know how much it's going to cost us today. That doesn't require any, mathematics or anything other than adding something up, maybe the costs. But it is the reason why we would buy that asset is because it's going to save us money or generate more revenue or do something positive in the future. It's going to make us more money in the future. Otherwise, we shouldn't be buying the asset. If it's not going to do that for us, we have no business buying it. But the question is it going to make enough money in the future to pay us back and cover the interest for using it right now, for paying for it right now? Okay, so we're going to apply this concept of present value to take that interest out of those future cash flows to see if it's worth enough today to cover the cost of that asset. That's the basic concept. So when we think about the idea of present value, all right, we're going to add interest in every period. So if you were thinking about investing money in a savings account or anything like that, it would earn interest and then you would add that to your balance, and then that interest would earn interest. And that's the term compound interest. That's what that means, is that the interest earns interest. So to figure out that how much you would accumulate if you were saving money for 20 years, let's say, okay, we would have to add that interest every year and then recalculate the interest. All right. And that's what the concept of future value does. It adds interest in a formula. And the easiest way to add interest is just multiply by 1 plus the interest rate. If we know how much things are going to be in the future, and we want to bring it back to today, the present value, we subtract the interest, which means we divide by 1 plus the interest rate. Now I'm going to show you, hopefully, a concrete example of what this might look like, okay, to hopefully bring this home. Okay. Now for a minute, don't worry too much about this table to your right, okay? But on this, here's what we sort of intuitively understand, most of us, is that if I had 5,000 today and I invested it at 10% interest, okay, I would have more than 5,000 3 years from now. Okay, that's usually we all are familiar with that idea. And in fact, it is going to be $6,655. And this is how we could do this the long way. All right. We could take 5,000, we multiply it by 1.1, we get 5,500. Then the next year, we make 10% on the 5,500. And so we multiply that 5,500 by 1.1 and we get 6,050. And then the next year after that, we do the same thing and we get 6,655. That's what's considered a future value. We're increasing the amount, but the point is, these really are equal, because if I had 5,000 today, I could invest it at 10% and I would have 6,655 3 years from now. Or I could just wait 3 years and you could give me 6,655 and I would end up in exactly the same spot, same position. That's the idea. So future value, or moving amounts from today into the future, does this multiplying. All right. Now, let's say that we have an amount in the future and we want to know how much it is worth today. Okay, so we're going the other direction. So we need to subtract out the interest, because we know in every one of these cases, what we have today is less, okay, in dollar amounts than what it is in the future. So in this case, we know what the future amount is, and we're coming back to the present. And the way we do that is we divide. And in this case, we're going to take the 10,000, we're going to divide by 1.08, and we get 92.59. And then we take that number and we divide by 1.08 for the second year, and we get 85.73, and divide by 1.08, and we get 79.38. Okay. So same steps, except dividing instead of multiplying, and we go down in our value instead of up. Okay. Now, what you see on the right-hand side is a table that allows you to do that in a shortcut. So in this case, we're talking about 8% interest. I'm going to move you over here for a minute. 8% interest on this table. 8% is how much the interest rate is per year. And 3 years, number of years or number of periods is down the left-hand side. So we go to 3 years and 8%, and we get a factor, is the term we use to describe this, 0.79383. If you see that, back to our little calculations here, that 10,000 times 0.79383, okay, gives us 7938, which is exactly what we got when we did it each year for 3 years. So basically the table is a shortcut for this process. As long as we pick the right percentage and the right number of years. All right. So I've given you a couple of other examples to show what happens depending on the interest rate. So we're still talking about 10,000. It's still 3 years in the future that we need to get the present value of. But because we use 11%, we see on the table, okay, that 11%, we use the factor 0.73119. And then multiply it, and it's 7312. So the higher the interest rate, the more the interest is subtracted out, right? And so the present value is going to be lower. And just the opposite, if the interest rate goes down, the present value will go up. In this case, we come over here to the 6% 3-year factor of 0.83962. All right. And then that will be your present value. So you got 3 different present values depending on the interest rate, all of which were for period 3. Now, I have a question for us. We have the table in front of us. Can you tell me what's going to happen to our present value, the amount today, if instead of 3 years from now, we're going to get 10,000, we're going to get 10,000 in 5 years? What would the present value be? Less or more or equal to what we got with 3 years? Anyone?
It would be more.
Nathan says more. Why do you say that, Nathan?
Because we'd earn interest on it.
That's if we were going this direction, right? If we had 5,000 and we were going up for 5 years, that would be higher. But we're going the other direction.
Okay, if we're going the other direction, then we're going to lose money.
Exactly. And you can see that in these columns. If you see, for instance, 6%, after 3 years, the factor is 0.83962. After 5 years, it's 0.74726. 7 years, 0.66506. So you see the amount, the present value of a dollar or of our whatever we're going to receive in the future is going to be less the further away it is from today. Okay. So does that make sense? Questions about the table or about present value? All right. All right. So this is, now the tables are in your textbook. They have a little different colors, but they're the same thing. So to use the tables, you need to know an interest rate across the top and the number of periods down the side. So this is, and notice this is the interest rate per period. Now for our purposes in chapter 5, we will use 1 year as our time period. At least each year will be its own time period. And then because we're doing long-term projects that last 5 or 6 years, we're not going to break it down by month or anything more fancy than just 1 year. Okay. Now, how do we take this concept of present value and apply it to our decision whether or not to buy an asset? Okay. So what we have to do is we have to look at our asset and identify the amount and the timing of cash flows. And we're going to focus on cash in and out for the most part on our decision making. So first of all, we'd have to decide what's the cash that's going to be spent on the asset up front. We need to know how much it costs us right now. That's the first cash flow you might want, you need to consider. And that may include not just the machine, it may include installation, it may include the fact that we'll need additional inventory in order to feed that machine. We may need some types of new wiring because of the electrical needs. It may have to be elevated, whatever. All kinds of those things need to be thought of. So it's not quite as simple as often you want to think that you can just go and pick it out of the catalog and boom, it's ready to go. All right. So the first one is all the costs it's going to take, the cash flow it's going to take to actually get the machine or new building or whatever up and ready to run. And then looking forward, now you should be able to get the cash flows for that machine pretty close. I mean, there'll be still some estimates. If you're having it installed, there may be some range of estimates, but that one, that number is going to be, you're going to feel fairly confident, hopefully, that the cost that you're looking at is real, and that it's not going to go way over that. Then you have to try to predict the future. Remember, managerial accounting, we do a lot of trying to predict what's going to happen in the future. And we're going to predict future cash flows. Now, when you do homework and when you see examples in textbooks and these kind of things, they are always going to make these cash flows like very definite. Okay. But in real life, that's not the case. It's not like somebody comes and delivers to you the future cash flows and a nice little package. You're going to have to make some pretty good estimates and do some work to come up with those estimates. So in the first year, how much is this new machine going to save us? Is it going to save us direct labor? Is we going to be able to cut hours? Is it mean that we are going to have less waste on our materials? So we throw less away, and so we'll use less direct materials. Will it reduce our utility costs, our variable overhead? Will our maintenance costs go down because this is a new machine instead of the old machine? All of those go into considering what our future cash flows. And of course, we have to speculate or plan how long is this machine going to do that before it either breaks or it becomes obsolete or something is going to happen that it needs to be replaced. So is that a 5 years, 10 years, 12 years? What is it? Okay. So let's say that we have those. those cash flows, and we've done a good job of estimating what those future cash flows are. We've been very careful to consider all of our costs to get this machine up and ready to go. We're not quite done in that we need to come up with a required rate of return. Now, this term is used multiple ways in real life. So some companies will call this the hurdle rate. Some companies will call this the cost of capital. Some will call it the required rate of return. So you'll see different, but it's basically the amount of return that you want anything you invest your company to make going forward. And it should be enough to cover the cost to get the money. So for instance, if you had to go borrow the money to buy this machine, then it should be a required rate of return should be at least that interest rate on that debt, and probably more than that, because you want to not just cover the cost, but be a little better than that. So that's what we refer to as the required rate of return, because remember, we can't go to our tables until we have an interest rate, until we have a required rate of return. So then we can calculate the NPV of the investment. And basically what we're going to do is apply present value to each cash flow in the future, and then add them up and compare it to what it costs to buy or set up this machine to start with. So that's our basic process in calculating net present value. Okay. Now, we can do that, and I will show you how to do that in, well, actually, let's do that, right? Let's do that first. Let's stop sharing and go back to my spreadsheet. Okay, and show you a quick example. Okay, and we'll toggle back and forth between this a little bit. So here's what I've done. We have an investment. We've come up with the cost of the equipment. The cost of new inventory is all referred to as working capital. Okay, that's the stuff we, in addition to the actual machine, that we have to have, supplies, other things that we need to have on hand at all times to keep this machine running. That's a total of $490,000. And then we looked at the future and decided that because we bought this machine, it was going to increase our revenue by these amounts each year. Notice they're different each year. Okay. And that it's going to save us money in some other way, maybe utilities or something. And so we put that in each of the years. So because this is a more than 1 year, and we've determined this machine is going to last us 6 years, we made 6 columns in addition to our investment. But this machine is going to increase our fixed costs. In this case, say for maintenance, it could be for some other costs just to keep the machine running that we didn't have before. So that's a subtraction. So they're going to increase our profits by these amounts and decrease it. And so we by the 3,500. And so we just sum that up, and we have our cash flow. This is how much this is going to improve our cash flow in year 1. This is how much it's going to be for year 2, year 3, year 4, year 5. Now, notice I inserted in year 4 the idea that we might have to do an overhaul on this machine, a major expense, not just the 3,500 a year, but this is like a redo. And if we anticipate that, we need to put it in our costs. and that at the end of the year 6, we're done with the machine and we can actually sell it for 75,000. Now that's probably very optimistic, but still. And that when we're done with the machine, we won't need the extra supplies. We'll be able to sell all that extra stuff as well, and get rid of it. And that will provide us with cash. So we have a cash flow for each year, which kind of summarizes all of the good things and the costs from this new machine. Now, in this case, I have to know what my required rate of return is, right? I have to know that it's 7% is what I put on here. And then I go over to my table and I put the table right on here, okay? And for year 1, I go to the 7% column and I go down 1 period, year 1, and I use 0.9345. And you'll notice that I put that factor right there in year 1. And then I went down 1 on that same column and put the next factor, 0.87344. And the next year, and the next year, and the next year, all the way through year 6. And I'm just going down the column for 7%. Okay. Each of these factors. And if the problem would have said 8%, then we would have used this column. If it had said 6%, we would use this column. Okay. So then we multiply how much cash we're going to get, okay, by that factor. So 86,500 after 1 year is the same as 80,841 today. 99,500 after 2 years is the same as 86,907 today, and so forth, with all the way down to year 6. 187,500 is the same as 124,939 today. All right. So net present value, and the term in accounting that says we subtracted something is net, is we add these up and subtract how much we had to make for the investment. How much did we have to spend for that machine, get that machine up and running? And my result of adding these up after the factor, after we multiply by the factor, adding these up, subtracting 490 is a negative 14,454. So our net present value in this case is negative. So these values added up are less than 490,000. So that's our the calculation of net present value. All right. Now, that is one way to calculate net present value, is to look up each of the factors on the table, multiply each of the cash flows by the appropriate factor, and then add them up, subtract the amount of the investment. All right. Now, going to go back to PowerPoint. Oops. I'm going to share.
So we wouldn't want to buy that machine because it would lose us money, right?
Yeah. That'll be the next slide, but yes, you're ahead of me, but yes, you're absolutely right. Okay. So there is a second way to do this in Excel. And by the way, in Google Sheets. It's exactly the same function. and it is net present value, NPV. So you can either type in NPV or equals NPV, all right, and this, and the parentheses will be there automatically, or you can go to FX, all right, and find the NPV function. Either way, if you do that, okay, then Excel is going to ask you for the interest rate. That's the required rate of return. It doesn't say interest, I said just rate. Now, Excel's smart enough that if you put 0.1 or 10 and put a percent sign behind it, it will treat it the same way. Okay. So if you type it in as 10%, as long as you use the percent sign, don't type out percent, it'll work. If you put in 0.1 or 0.08 or 0.07 or 0.075, those will all work as well as percentage. So you can either use the decimal version or a percent version in Excel. Then it wants to know the value. That's the cash flows. That's the future cash flows. Only the future cash flows for net present value. And the easiest way to do that is just to highlight it. Remember when we did our regression, we just chose the fields and made sure it was all highlighted in the color that we anticipated. The same way thing happens here in Excel to do the net present value. Okay. So if I go back to my example, this right here, right below it, the second net present value, is doing it the way I just showed you in Excel. So I used NPV. I typed in the 7%, or if I put it in a cell, I can reference that cell. And notice here, okay, I've highlighted in blue the future cash flows as part of my formula. Then, and don't forget this, that will tell you what the total of those is. Now notice that when I do it this way, I am not totaling up these. These have been adjusted for present value already. Excel is going to do that for us in this way. So you want to highlight the 86, 500, 99, 500, 102, 500, so forth. And then add, and because I always put the investment in as a negative, add the investment, which is the same as subtracting the investment. And you see that because of rounding, we get just a slightly different answer if we use the formula or the Excel automatic shortcut, however you want to refer to it in this case, but close enough that it's never going to make a difference in our decision. Okay. So there's two ways to do it. Obviously, either one of them is easier in Excel by itself. Okay. But here's the nice thing about this. If we do it with the formula, and I want to say, well, what would happen if my interest rate went down to 5% instead of 7%? Would that make a difference? And the answer, of course, is it's yes, it's going to make a difference, but how much? And all I have to do is change that one number in Excel, and I can look at what 5%. If I want to change this other way of doing it to 5%, I'm going to have to look up each of these factors again. I'm going to have to do 6 changes to make that change. So that's why we love Excel and using that type of formula, because that makes it much easier to look at multiple scenarios and that sort of thing. All right. So since we got Nate got us a little bit further along. Okay. Oops. Let's go back and how do we make the decision? A positive NPV indicates how much better the firm will be off by doing the investment. So if you get a positive NPV after subtracting out the investment, if it's 5,000, then that is our estimate of how much additional profit, cash flow will happen because of this investment over what it costs us. And so the idea is that if it's a positive NPV, we should go ahead, while negative NPV says don't go ahead. Now be a little cautious. You probably should not use NPV to rank alternatives unless they are very, very close to the same investment. You shouldn't say, well, if one investment makes us a $10,000 NPV and another one makes a $5,000 NPV, that we should only do the $10,000 one. Because literally every investment that makes a positive NPV, technically, according to the theory behind this, should be undertaken. NPV should not be used to decide who's first and what's second. All right. We will see a better tool for that in a little bit. Okay. Now, when you get close to zero, now remember that this whole thing is an estimate. The only number on this whole scenario that we have a lot of confidence in is the cost of the machine. All of the future cash flows are our best estimate, and we have worked really hard to come up with them, but they're still not exact. So when we get close to zero on an NPV, that means that we're just barely covering the cost of the asset. Then our decision, I'm just saying, if your NPV is $2 or your NPV is a negative $2, that's not very much difference in real life, given that you've estimated your numbers. So if you were to say, okay, it made us $2 on NPV, let's do that project, and this project has a negative 2, we won't do that one. I'm telling you that you don't know that exactly. And so maybe you should look at other alternatives. Maybe you should consider qualitative factors. Remember, we talked about those in the last chapter, reasons other than dollars and cents that you should do the project or not do the project. So maybe it's an NPV of -3, but it's something that would very long term put you in a position of having a better reputation or something like that. Maybe that you can't measure in dollars. Then you say, okay, I'm going to do it because that -3 is such a small loss that it'd be worth it to have this project and be able to tell the world that we are more environmentally conscious, perhaps, or maybe something else about that project. It makes it good enough. If it's lots negative or a lot positive, then you know, not that those qualitative factors shouldn't weigh in, but maybe they take a second backseat to the actual dollars, because you can feel pretty confident that if it's got a very large positive NPV that it's going to be a good project unless you really made a mistake. In real life, no business is going to invest millions of dollars, and that's what sometimes we're determining is literally millions of dollars without running multiple scenarios. What if this machine only lasts 4 years? What if this machine requires higher maintenance costs? What if this machine is able to increase production more than we thought, less than we thought? All of those, and looking at all those possibilities and seeing if you could make money or have a positive NPV even when bad things happen, even if there's a worst case scenario. You may sometimes see people do a best case scenario. This is if everything works with the machine perfectly. A worst case scenario if everything doesn't work, and a most likely scenario, someplace in the middle that is what we really think is going to happen, and compare the NPV on all of them. The worst case scenario should almost always be a negative NPV, but how bad, okay, may help us decide whether or not we want to go forward. Okay. All right. So there is a second evaluation tool that we're going to also learn that's closely related to net present value. It's called the internal rate of return. And it is the percentage return that the investment will provide and make zero. Okay, the NPV would be exactly zero. So we saw in our example in Excel that if I change the interest rate, it changes my net present value calculation. At some interest rate, the net present value will be exactly zero. So while you can do that using the tables, it's very difficult to do so. And so it pretty much needs to be done in Excel, or at least to make any sense, okay? And the decision rule is, okay, so our decision rule for an NPV is a positive NPV, go with it. Negative NPV, you say zero, you don't go with it. Close to zero, you decide on based on other things.
I have a question.
Go ahead, Medea.
I'm wondering, like, how they used to find the percentage value without using Excel. Is there like a way?
The percentage values in Excel.
No, how they used to do it before Excel exists.
Oh, how did they do it before Excel?
Yeah.
Oh my goodness. There's actually a mathematical formula that you can do this. And it's divided by 1 to the 1 plus interest rate to raised to the number of years power. So it's a lovely logarithmic function that mathematically can be figured out. And that's how they had to do it. They just get your calculator out and plug in bunches of numbers. And if you made a mistake, you had to, clear your calculator and start over.
They showed that in chapter 5.
Yeah, nobody uses that. I won't say nobody, but I don't usually spend a lot of time on that. But yeah, that's how it was done and has been done for a long time. And it literally, that's what Excel's doing. It's just doing it in a microsecond, right?
Yeah.
Okay. So that we don't have to worry about it. So the decision tool for IRR is it must be higher than our required rate. So if our IRR is 8% and our required rate of return is 7%, then we would do that project. If it's 5%, we would not do that project. Okay. Unlike NPV, we can use IRR to rank alternatives. So if you're looking at two projects, okay, you want to do the one with the higher IRR more than you do the one that has a lot. They both might be bigger. They might both have a higher IRR than the required rate of return. And therefore, in pure theory, you should do both. But if you have to choose between the two, you would do the one that has the higher IRR. That would be make you the best return on your investment. Okay. So like you said, it can be guessed using the present value tables, but so much easier in Excel and very difficult in without Excel. So this is how the function IRR works in Excel. Equal IRR. Same way as NPV, similar. But here's the quirk, and this is what you want to make sure that you write down, okay? You are referring to the cash flows, just like we did with NPV, but the initial investment as a negative number needs to be the first number you highlight. So first of all, ignore the guess part. There's no need to do the guess. I wish Excel would take that guess out. Excel doesn't need that guess anymore. That was from a very, very, very old Excel version back when I was, well, even before I was in college. That was needed, but is no longer needed. Okay. The values will just be the cash flows, and the first value should be a negative number. If you don't choose a negative number in the first cash flow, when you highlight, Excel will give you an error. Google Sheets will tell you you have an error. Okay. And then all it'll say is error, and you won't know what it is. And you just go back and see if that is the first number that you're referring to in your row or column, however you set this up, is a negative. Okay. So looking back at our example in IRR, here's what I've done. Notice what's highlighted. Remember when we did NPV, okay? We highlighted the future cash flows in blue and the investment in red because it's a different part of the formula. That is not the case with IRR. Okay. It is the whole thing. And notice that the first number, B9, this column B9, is a negative, which is why we get an actual answer and not an error. So let me show you what happens. Okay. It says you're num. Okay. All right. However you want to take that. We'll fix that again, and we're back to an actual number. Notice that in this case, 6.12 is less than 7, and so we would not do this project, just like we decided with net present value. And that's almost always going to be the case, meaning we should come to the same conclusion using NPV or IRR, except in a few cases, which is why we learn both of them, okay? And because IRR can be used to rank them and NPV cannot. So if we need to rank them, then we prefer IRR. All right. Questions about those formulas? in Excel?
So if the IRR is lower than the interest rate, then we shouldn't use it, correct?
Exactly.
Okay.
But you should use that rate, but you shouldn't do this project, right? Is that what you meant?
Okay. Yeah, that's what I meant.
Okay, good. Yes, it's coming up with the interest rate for you. And if the interest rate is lower than what you required, see, if you think of it this way, the term required rate of return says I need to make 7% or I shouldn't do it, right? And if I'm only going to make 6, I should say no. Okay, that's how the best way I can think of to remember that rule. All right. Okay, so just to wrap things up here. We are focused on cash flows, how much money goes out, how much money comes in the future, especially. All right, so this is not really cost of goods sold. We're not worried about that much about whether it was accounts receivable or any of those other things. We're just saying this is the cash spent. This is the cash coming in from these. And remember in your mind that these are estimates. Nothing that we're doing when we try to predict the future is exact. And so small differences between things are not going to be that big, because especially when you're talking about when I start thinking about and trying to project what's going to happen 5, 6, 7, 8 years from now, I am in really speculative territory. And therefore I understand the further I go out, the less sure I am of what's going to happen. Okay. Don't forget qualitative factors that may overwhelm things like reputation or employee morale, things like that, for example, which may override some of the dollars in this, especially if it's close to 0 on NPV or close to the required rate of return for IRR. Okay. So ethics kind of thing that you can see, these are long run decisions. Okay. Sometimes making more money in the long run hurts our profits in the short run. Let's say, for instance, that a machine for the next year is going to not make us a lot because we're still learning how to use it. But after that, it's going to kick in. Well, we may look at our process and we may see that NPV that actually works based on future cash flows. But as a manager, if we're worried about our bonus just this next year, we may say, I don't want to do that project because for this next year, I'm going to have a lower profit and therefore not get my bonus. And so some people may be willing to let short-term considerations, personal considerations, outweigh long-term health of the company. And that's a problem. So we need to be careful that we build that into our process, that we don't let a project get nixed because it's going to, for the next 6 months or next year, make us lower profits that eventually in the future is going to really pay off for us. And then, of course, since these are all estimates, there's judgment in there. And of course, if there's somebody who's against a project or is for a project, they may unethically, in some cases, change some of the numbers because, again, there's nothing to check them against. There's no right answer about how much cash flow is going to come in year 3. and they may override, they may ask, put things in there that are maybe over exaggerations or something like that to make it work, so that they can have it happen or not happen depending on what their personal considerations. And of course, those are issues that we want to try to avoid, but are kind of going to come up at some point or another, because some way or another, there's a judgment call in these estimates. Okay. Don't forget the idea of future cash outflows. That means like a large expense, like halfway through the useful life as an overhaul. Maybe if you're looking at the payoff for a new long range diesel truck, for instance, you should probably, yes, it lasts 15 years, but you should plan that every 5 years you're going to have to do a major engine overhaul. And so it may not just be the cost up front of that diesel. It may also be, you need to consider that every 5 years you're going to have, because those aren't cheap. He talks about tens of thousands of dollars overhaul every 5 years. And so that is part of your net present value if you're trying to consider whether or not you should make that investment. And then the concept that we showed in our example, working capital, that refers to any additional supplies, inventory, other things that we are going to have to buy and keep around. Now, what seems a little bit odd about that is we're not going to just buy it once. We'd have to buy it and use it and keep it going. But because that would basically come out of future cash flows, we usually only consider the fact that we invest it now and that it'll just turn over. So it's a working capital in year 1 or year 0 in the right now, and that working capital will get paid back to us at the end of the useful life of the machine or of the truck or of whatever the asset is. Okay. So those are two things that I showed in the example that you want to make sure you're reading carefully through your homework, that you look at and make sure is in your model. All right. Break it down by year. I don't think any of the examples are going to have actual specific years. It's just going to be year 1, 2, 3. Your beginning, the year 0 or the right today is going to be what you have to do to get the machine or other asset ready to go. That's your investment. And then the first column after that will be your year 1 and what's going to happen with either increased revenues, lower costs, whatever other things are going to happen because of that. And all of those are going to be given. You don't have to estimate these in our homework because, well, that would be really actually the hard part of this whole process, is estimating those cash flows. We understand that we really can't simulate that in a homework environment such that you could do that. So that is chapter 5, and should get you ready to work on homework, which is 26, 27, and 28. So 3 problems right together. And they're all involving net present value or IRR or both. And I would encourage you to do them in Excel. Oh, let me show you. Oh, where did I put my? Let me think. I have example. Okay. Google Sheets. For those that might want to use that, I just copied the same example into Google Sheets. You'll see it got likes the minus sign. I think we talked about that before. Maybe not in this class, but when somebody using Google Sheets noticed that it was hard to get the parentheses. Okay. The formula is the same for net present value. I will show you something when you do equal NPV. Notice that it doesn't call it a rate, it calls it the discount. So another term for required rate of return is discount rate. All right. So that's the big difference there. So just wanted to point that out so that if you are using that, and equals IRR, and it just refers to as cash flow amounts. It wants you to guess as well, which you don't need to do. Okay. Just remember that your IRR has to start with a negative 490 and use this row all the way across. So you can see it there highlighted in yellow. Whoops. Now sort of it drops down in front of you. Okay. So don't let using Google Sheets get in your way. It works exactly this, almost exactly. There's not much difference here as there was in the regression in terms of how it works. There. Okay. Any other questions? Concerns about chapter 5?
In the final exam, how they gonna put those questions? Like, are we gonna use the Excel?
Yes, you'll be able to use Excel in the final exam as well.
Okay.
Anybody else? Anything about how to work Excel on those? All right,
All
then.
this is recorded, right?
This has been recorded since I started a little bit late, but it got all the
Good stuff I need.
good. Yeah, just I think we only missed the review of those
Okay.
assignments at the first.
You know, I don't need no.
So I think you should be able to go back and look at it. Any other questions about how to do that, decision rules, any of that? Okay, so then I'll let you go. If you have more other questions, feel free to stick around, and I will try to answer them the best I can. If you're good, go and do your work on your homework is for the last few minutes of class, and get it in by Thursday, and same pattern. We'll make corrections to it if needed on Thursday.
Thank you.
Thank you. We'll see ya.
Thank
you.
you.